Hey, what's going on, everybody? It's Monday, January 10th. Panic setting in. We had a big down opening today in the markets. Actually, I think today was a day. First of all, I covered my defensive short positions today on the opening when we were down heavy. I think right now what we are seeing is a culmination or an example of a big overreaction, emotional overreaction by investors, with this selling based on the shift in Fed monetary policy. At least that's what I think it is. I mean, maybe it's, the virus having something to do with it. That's more of a concern. That's a real concern, but I think the reaction, you can trace it back really to the Fed's hawkish comments. You could trace it back to, last week's, the minutes of the last Fed meeting and their shift in position. And I've been going over this. I've been talking about this, how, this is number one, pure emotion. And number two, really based on a lack of understanding about monetary policy and the implications. Before I get into that again and go over it, let me just say that the recent data on bank lending it's fantastic. It's very strong. Just a couple of points here. Loans and leases in the week ending December 29th increased at the fastest rate in 14 months. I'm just reading it off the screen here. Commercial and industrial loans, I've been talking about those. They're primarily used to finance inventory. They were up for the 6th week in a row, and now they're at the highest level in 7 months. So again, to me, this points to a restocking of the shelves. Companies are now investing in inventory. That says two things. Number one, they have access to inventory. Before they didn't because of the supply chain issues. And number two, rising inventory should mitigate some of these price pressures that we're seeing. Consumer loans, rising at the fastest pace in 6 years. Okay, you're talking about credit card and revolving credit, automobile loans. And finally, bank residual, and this is just some of the bank data. In my report, I have a whole entire list of the banking data each week, and I break it down. But residual, which is assets minus liabilities of the bank, literally bank capital, saw the biggest increase in 12 years. All right, so bank capital is really the only constraint on bank lending. And if it's going up like that, banks have much more lending power now with more capital. But here's another thing I want to touch on, and those of you who have been following along with my videos, or those of you who are subscribers, you should be catching on to the fact now of how the mainstream view of how the monetary system functions, particularly I should say with respect to banks and lending and bank credit. The mainstream view is that, when the Fed pumps in reserves, then the banks turn around and lend it out. This is a view even held, at the highest levels of economic, academics and central banking. And of course, it's completely wrong for reasons I've explained so many times, that bank reserves are assets, and assets need to be backed by capital. And when you're dumping in trillions and trillions of reserves through, Fed QE or whatever, you are forcing the banks to either raise more capital or to slow the growth in other assets, namely loans. Now we see a perfect real-time example of this playing out in the reverse. Reserve balances have fallen to the lowest level in 6 months, and lending is taking off. It's accelerating, all right? And this is also happening. Here's another fallacy that I know a lot of people subscribe to, is that higher interest rates are going to curtail lending. We're seeing market interest rates surge right now, and lending is exploding. So this should, I hope for some of you anyway, squash some of these myths about, bank loans and monetary policy and reserves. Okay, reserves can't be lent out. I mean, they could be lent from one bank to another overnight, but there's no change in the overall amount of reserves in the system when one bank lends reserves to another bank short term. Reserves are created, new reserves are created when banks actually make loans, and they make loans simply by, finding a credit-worthy borrower, and it's making sure that the bank itself, has enough capital to, to back those loans, to substantiate those loans. So, very interesting what's going on. Look, I've been talking about the slowdown in fiscal. It has slowed down. I mean, that's it's really not up for debate. But it's not a precipitous slowdown. I mean, we're still looking probably somewhere about 500 billion per month in monthly flows. There's even some talk, I even heard some talk, Pelosi's talking about more stimulus. Biden was talking about more stimulus. I don't know if that's going to happen given the politics and the way the Senate is split 50-50 and not even 50-50 because a couple of Democrats, we know Manchin's not going to go along, Sinema's not going to go along. So we don't know if that's going to happen. But anyway, February 18th is when Congress has to pass either a new continuing resolution or finally come up with a full year budget. So we'll see what happens then. There's still some time. But mainly I wanted to say, look, we have very, very high levels of bank credit expansion right now. And, I guess you could argue that, hey, that's not a good thing, Mike, because you even told us that, bank loan comes with an offsetting liability, which is the loan itself. That's the debt that you have to pay back, and you have to pay that back with interest. And I agree with that, but I would say that, debt service burdens. In other words, how tough is it to service your debt every month? Can you make those payments? Debt service burdens as a percentage of disposable income is still at very, very low levels. I mean, we're nowhere near the level we saw in 2007 when it was like 13% of disposable income. Right now it's about 9%. So that's definitely a level where we could see more loan growth. And even as the fiscal slows down a little bit, bank lending will fill the gap, at least for a while. I mean, if we get back up to 11, 12% of disposable income, 13%, yeah, that would be a big red flag. But I don't see that right now. I see all of this as an overreaction, and again, it is, it is made glaringly evident. I mean, when everyone's freaking out about higher rates and Fed shrinking the balance sheet, and the reason behind that, the reason they're doing that is they feel like that is a tightening, when in fact the actual result that we are seeing is an expansion of money creation by the banks. So it's the opposite. It's the total opposite. Nobody really realizes that. I'm trying to explain that to you. Hopefully you get it. But that is the reality of what is happening right now. And it makes total logical sense if you understand the relation between, monetary policy and the effect on the banks, particularly in how it changes reserve balances and the composition of bank assets. Very important to know this, okay? And the market has it wrong. I'm telling you right now. I covered my short positions this morning. All right, everybody. See you tomorrow. Bye.